Good morning. Welcome to Business Finance. Here we go, getting started. The first couple of chapters here. It's just a review. I'm gonna go over this really quickly. You may or may not even really need to listen to this or watch this. If it helps you with the quiz, great. Again, the first couple chapters here are just review, and then we get into some other stuff. And so I'm going to go through them quickly. I will probably separate this into two quick videos. And there's a lot of slides, but again, I won't spend a ton of time on them. And away we go. So economics, yeah, we talk a decent amount about economics and finance. I follow the daily economic news and whatnot because of the effects that it might have on finance, interest rates in particular, and other things like that. So accounting gives us data that's wonderful. I always said I hate accounting, but I love accountants because they provide all this stuff that I do like to analyze as a finance type of a person. So, and finance definitely links the two. So in the 1900s, finance kind of emerged from economics. Um, Probably we were getting better at putting together data and whatnot in accounting types of a census and accumulating data so that we could review it and do those types of things. So in the 30s, right, the Depression, so capital preservation was key. Liquidity, meaning having cash available is real simplified, I guess, definition of liquidity, but having cash or assets available in order to do things, right? Reorganization of financially troubled corporations and bankruptcy processes. Sounds like the Great Recession too that we just had in the 2000s. In the 50s, more analytical. Again, we were getting better at accumulating data and putting it together and whatnot, right? Financial capital, we used money to purchase real capital. Probably a lot of borrowing and those types of things that were going on coming out of the war. Different things were going on. More public corporations, more people getting involved in those types of things. So modern issues, right? Risk return. I'll say often and maybe throughout this course, but in other courses as well, that risk always goes with return. If you see somebody that's advertising that you can get a 20% return for them, understand that that's going to be a risky investment. Just no question about that, right? And so be wary of those types of things, and people that make those types of guarantees, a red flag should automatically go up. Doesn't mean you shouldn't look at the guy that promises a 3% return as well, because there could always be risk involved in that. We definitely want to maximize our return for whatever our given risk level is. Portfolio management, similar to personal investment. Companies, they end up sitting on a decent amount of cash sometimes. And what do you do with that? How do you invest it? How do you keep it liquid? How do you keep it available? But how do you get a good return on it as well? And then capital structure theory, we'll discuss, and we'll spend some time talking about that and going over that when we look at equity versus debt, basically, when we talk about structuring our capital base. So lots of new financial products with focus on hedging. Hedging can be oftentimes considered kind of a bad word when we hear about it, when we talk about the financial industry, and you'll hear in the upcoming presidential campaigns, especially from Bernie Sanders and Hillary Clinton, saying bad things about hedge fund managers and those types of things. Hedging in a real traditional sense was an excellent tool. An example up in our country is simply this. If you say this time of year you thought the price of wheat was pretty good, you might future contract sell your 2016 wheat production for fall delivery, right? You've locked in a price. But what happens if the price goes up? Well, you can hedge, or you can buy some finance products that would protect against the price going up, or allow you to take advantage of a growing price. And that's the simple hedge. Now, hedging gets a bad name because there's so many financial products, derivatives, and other types of things that are available now, and some of them were involved in the 2007 financial meltdown that we had that led to the Great Recession. So, inflation, not something that we hear a lot about, because inflation has been unbelievably tame for a fairly long period of time, but that hasn't always been the case. Go back to the 70s, we had horrible inflation. So significant factors, right? Yep. Let you guys kind of read through those. It's kind of funny today because the price of gas has been coming down like crazy, and it doesn't look so bad. It doesn't look like we necessarily have to bump up our credit limit on our credit card to fill up a tank of gas like we had to a year or so ago. So, and it's kind of looking like the prices are going to stay down for a while. So, why did we have the recent financial crisis? Yeah, extensions of credit, primarily in the mortgage side, right? We were making subprime loans, they were called. So loans that when I was in banking, we'd had never dreamed of making. There's just no way. And a lot of those got made, and people just thought the market was going to keep going up, and so it didn't matter. We'll lend these people money even though they're marginal, because 3 years from now their house is going to be worth more anyhow, so we won't lose any money, and created a big bubble that obviously burst. I was just reading an article today about how we might be doing the same thing with vehicles right now, that people are buying more and more expensive vehicles because rates are so low that they can. And they're extending out the terms, longer period of time to pay for a vehicle that depreciates very rapidly, things like that. And so may or not be true, time will tell. I've also heard that in regards to student loans. There's $1 trillion of student loans out there. So again, complicated, unregulated products like credit default swaps. And credit default swaps were similar to hedging. They weren't a bad product necessarily, but they just got overused. They became used too much for speculation, and hedging's much the same. If I had a customer back when I was in banking that did legitimate hedging, I thought that was wonderful. But when they started speculating in those markets, these are things that have happened, right? We had government action. We had some bailouts of certain companies. They let Lehman Brothers go, but they bailed out AIG and bailed out GM and a few others, and Citigroup, and all kinds of new regulations. Yeah, we got Franken-Dodd and Consumer Financial something. Yeah, they call it Dodd-Frank. I still visit, obviously, with a bunch of my old banker friends, and I prefer to call it Franken-Dodd, but okay. It purports to improve these types of things and maintain stability in the financial system. Consolidates regulators, hopefully. What I've heard from my banking buddies, though, is that it has tended to thwart their efforts to increase lending, right, to small business people especially, but also to a certain extent to consumers. And that is at least part of the reason maybe our recovery has been relatively slow, relatively subdued compared to past recoveries. Their opinion, maybe. So, Volcker Rule. We used to have something called Glass-Steagall that separated investment banking and consumer, basically banking, or traditional banking, I should say. That broke down in the 90s, actually, when I was in banking. And the Volcker Rule kind of tried to bring that back a little bit. And we'll talk about that more thoroughly, I think, later when we get to the end of the semester. So, yeah, the Franken-Dodd set up the Bureau of Consumer Financial Protection. Okay. Internet accelerates e-commerce solutions. Yeah, we're seeing some really weird things going on, right? Amazon's growing like crazy, as are a lot of other companies, Uber, Lyft, different companies like that. Just some really, really interesting things that are coming along. The eBay model is still existing, and I think they're still doing okay, but it's kind of taking a back seat, certainly to Amazon, but also other companies that are out there. So, Um, yeah, products bought with credit cards or debit cards. PayPal has become big. Processing those things through PayPal. Um, Credit card, yeah. Just trying to see if there's things here that are extremely important, not terribly. Yeah, financial management concerned with managing an entity's money, right? How do we allocate funds and how should we allocate, right? To get the financing alternatives, debt versus equity. Again, you'll hear me say a million times, debt's always cheaper than equity. I'll stick by that. And develop an appropriate dividend policy, maybe. Some companies pay dividends. Apple reluctantly started the dividend policy just a couple of years ago. Berkshire Hathaway, one of my favorite companies, has never paid a dividend and very likely never will. And so, those types of things really depend on the management of the company and how they feel they can invest the cash that particular company has. So, daily things that financial managers do, right? Inventory control, receipt disbursement funds, da 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 da. Occasionally, do we need to issue new stock, or if we're a new company and creating an IPO, right? How about bond issuance? And bond issuance is borrowing money, basically. And we'll go over pricing of bonds and those types of things. Capital budgeting, where do we get our money from? Do we borrow? Do we leverage? Do we do those types of things? And then should we pay a dividend? Okay, and again, it's always a trade-off, right, between risk and reward, and ultimately we want to maximize shareholder wealth. Sure, the operational side obviously gets some trade-offs, capital versus labor. Do we buy robots, those types of things? Decisions that, even fast food places or quick service restaurants are going through, right? Do we need that person up in front taking our order? Or can we set up a kiosk, or can people just place their orders using their smartphone and an app? Domino's is kind of doing that. And granted, Domino's is all takeout or delivery, but they're really pushing people to use, right, their different apps and whatnot as opposed to actually talking to somebody. They can eliminate a position possibly by doing that, okay? Maybe take some investment on the front end, capital, right? But they save it in the long end there. So influences the financial mix, stocks versus bonds, and we're going to talk about that. Forms of organization, been through those a lot, both in law class and probably accounting would be my guess. And I'm going to let you guys kind of go through those: sole proprietorships, partnerships, limited partnerships, corporations, S corporations. What's becoming more and more popular for small businesses anyhow are the LLCs. I would say, based on my experience here locally anyhow, agency theory, right, examines relationship between owners and managers of firms. We see a decent amount of that stuff going on, even with bigger companies, and you get some old folks, activist investors, they're called, moving in and trying to get different changes to be made and whatnot. Institutional investors. What are institutional investors? They include things like the Montana Public Employees Retirement System, right? CalPERS is even a bigger one, which is California Public Employees Retirement System. And imagine the money that goes into those types of accounts and those people that manage those. So those are institutional investors. But as are mutual fund managers and ETF managers and others like that we'll talk about. Sarbanes-Oxley, I remember we talked about that in business law class. Set up some different things. You guys can review those. Okay, primary goal, right? We want to maximize profit, but also do that while maintaining a reasonable level of risk, I would say. Okay, change in profit, yep, can also represent a change in risk, absolutely. A goal of maximizing profit can fail to consider timing of benefits, right? And it's impossible. You don't know what's going to happen in the world in terms of recessions, weather, all those types of things. A lot of stocks got hit really hard, Under Armour, say, being one, because it was so warm in the Northeast this year. And so they didn't sell a lot of their cold weather stuff, and they're going to have to sell it at cheaper prices, et cetera, right? Broader goal, and more the long-term goal, and probably the more important goal, is maximizing shareholder wealth. Okay, achieving the highest possible value for the firm, or I would say instead of the highest possible value, I would probably say the highest possible return for the shareholders, right? And those can be kind of different things, depending on a dividend policy and some of those other things. So only way to retain power when we're talking about shareholders and whatnot. Well, yeah, unless you're Mark Zuckerberg and the shares that you issued were B shares that don't have the same voting rights and whatnot, right? Stock options are a big deal. We'll talk about stock options a little bit later in the semester and how those work, and we'll talk about them in terms of dilution of returns and some things like that. Powerful institutional investors, right? They're putting their foot down sometimes. When CalPERS has billions and billions, tens of billions of dollars, and they might invest those with a few companies, they can make some pretty high level demands. And valuation approach. How are the earnings valued by the investor, right? and these are the things, if we're going to be an investor in companies, and this is kind of what our project 2 is going to be, right? How we want to look at things, right? Risk. What kind of risks are involved if you look at Apple versus Microsoft versus Exxon, say. Who would have thought that the price of oil was going to get down into the $20, with a 2 handle on that. And so Exxon, huge company, relatively risk-free, and all of a sudden maybe there's risk there that may be bigger than we would have anticipated. A time pattern, right, over which firms' earnings increase or decrease. Quality and reliability. There are companies, for example, J&J. Year after year after year, they just plug away and make money, and they have a solid balance sheet, and on and on and on. Okay, versus companies that tend to go up and down a lot more. Maybe some of those commodity-based companies like an Exxon or gold mining companies, things like that. So, by the way, Exxon's probably going to be just fine, but there's a whole lot of oil and oil service companies that are going to go broke, okay? Because of the impact of the oil price fall. Social responsibilities and ethical behavior. Of course, Milton Friedman would have told you that financial management shouldn't even think about those types of things, right? Other people might say that if we have a socially responsible company that practices ethical behavior, it might actually increase the value of that company to others. So I'll let you guys kind of decide that. So insider trading, of course, is illegal, and it's interesting, some of the cases that have happened there. You can go back and review some of those. Martha Stewart was perhaps one of the more famous ones, but there's been a lot. The Attorney General or the New York State Prosecutor, because of the New York Stock Exchange being there, has actually prosecuted quite a few here in the last several years and done so did so pretty well, but a couple of them actually fought back and then were successful. And role of financial markets, right? Yeah, participants can be individuals or public, private, government institutions. The public employees' retirement systems are very, public institutions, right, that do investing and those types of things. And then we get into international markets too. Can we buy stock internationally? Absolutely. And do we want to? Hell, maybe. And there's ways to do that would be less risky than others, right? Corporate and government markets, we'll talk a lot about bonds and whatnot and what might be available out there. And then money and capital markets. Money markets deal with short-term securities. Might be commercial paper, might also be CDs, might also be, it can be government bonds or government securities that are sold that are less than a year length or that have less than a year of time length, right? Capital markets, we're talking about things that are more enduring, right? Long-term markets, and those types of securities include common stock. Preferred stock's not used a lot, but you'll see that with some companies. And then, of course, corporate and government bonds versus bills that are short-term bonds or longer term. When a corporation uses financial markets, we call that a primary market. So that's the initial public offering when they go public, and you know, raise money for the first time. A fairly recent example might be a company called Shake Shack. It's mostly in the East. We haven't seen those here, but it just went public, you know, in the last year or so. That might be one that you could look up. SHAK is its ticker symbol. Secondary market is the buying and selling. That's typically what you and I would participate in then. If we wanted to buy or sell stock of a certain company, we could certainly do that, right? Yep, investors can choose risk levels. We'll talk about the different types of investment products that are out there a little bit. So again, we'll mix in a little bit of personal finance with corporate types of finance decisions, because they're similar. You know, as a financial manager, you might be dealing with a lot of the same products that you would as an individual. Firms pay a penalty for failing to perform competitively. So restructuring, you know, we've seen actually a lot of restructuring over the last several years just because rates are so low. You know, companies maybe that initially dispersed bonds or sold bonds at 7% interest rate, they can refinance at 2%. Why wouldn't they if they can? You know, if they can pay off those bonds, if there's a call feature on those that allows them to pay those off. Yeah, and so companies will do that, certainly. So you get a decent amount of restructuring for those types of things, right? We also see companies that are restructuring or changing the way their company is set up. GE is famously going through a huge restructuring. They're selling off big parts of what their company is. And we're also seeing recently a lot of mergers and acquisitions. We're not seeing a lot of momentum in terms of companies really growing organically, they'd call it, but we're seeing a lot of mergers and acquisitions. We've seen it in the pharmaceutical space and a few other spaces. A lot of people are predicting that we'll see a bunch of these in the oil and gas as companies start to really go broke. They might get picked up, you know, 10 cents on the dollar. A company like Exxon that is still solid, or Chevron or ConocoPhillips might pick up those types of companies. So yeah, allocation of capital, that's internationalization. So there might be a capital available overseas that's even cheaper, right? And we're actually seeing a lot of U.S. companies that are moving offshore, and they're doing that because of the tax implications. They call it an inversion anyhow, and we're seeing a lot of that actually happen. So, and that's an interesting thing. Technological impact, yeah, cost reduction, and I mean, we can trade securities all over the world now and do it easily sitting at our computer, right? And it's just amazing, you know, how that's changed. So we'll spend more time talking about those a little bit later. So I know that's rapid, and I kind of did that on purpose. I don't want to spend a ton of time going over these reviews, so hopefully you guys can get through that. Chapter 1 quiz and the Chapter 2 quiz I'll be sending out soon. So, or the Chapter 2 video I'll be sending out soon. Thanks, and next week we'll get started on Project 1.